warm welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, it's the time of the year when we ring out the old and ring in the new, when we take time out before the partying begins to look back on the year gone by, on the lessons learned and still unlearned, the hopes and opportunities for the new year, and of course, indulge in a bit of crystal gazing as well. And joining me in this are two experts. Jagannathan, Editorial Director, Swarajya magazine, and if I may add, one of the more mature and saner voices in Indian journalism, Anantha Nageswaran, Dean IFMR, Graduate School of Business, and now currently also non-permanent member of the PM's EAC. Let me also add that as is to be expected from a show called Macros with Mythili, we will be looking at the past and the future, but through an economic prism, focusing only on the macroeconomics and steering clear of politics. Admittedly, that's not going to be easy, especially since another and perhaps better name for macroeconomics really is political economy. So any discussion on macroeconomics can never be devoid of political overtones. But we've done the next best thing. We've taken a great deal of care and thought in selecting our experts so that we can present our viewers with a dispassionate assessment of the state of the Indian economy and a wish list for the future, devoid, if not of politics completely or per se, but definitely of party politics. So with that rather long introduction, let me welcome to the show Jaggi, Ananth. Let me start by asking both of you in turn, how would you look back at the year gone by from the economic perspective? As a year in which the economy plumbed the depths, with growth falling from 8.1% in the fourth quarter of 2017-18 to just 4.5% in the second quarter of 2019-20, with really not much hope for improvement, or one that really marked the beginning of the recovery. Never mind what the numbers tell us. Is the worst behind us? Let me start with you, Jaggi.
Well, Mythili, I don't think the worst is behind us. I think we probably have 2 more quarters of struggle, though some base effects might make a little difference. And we do see some early green shoots of revival in some sectors. I mean, the automobile slowdown seems to have stabilized a bit, and some other telecom guys have started raising tariffs and various other things. But I don't think we are going to see a substantial revival till we are well into the next fiscal year. And once all the measures that the finance minister has announced start playing out. And also the year has been dominated by a rising crescendo of politics rather than economics. Even as the slowdown has been there, the government has been doing a lot of political actions from Article 370 to the CAA and other things. So it will take some time for the politics also to play out on the economics, because let's not forget, when politics raises such a churn, it is going to impact economic sentiment sometime or the other. So I would think that we have, anyway, this quarter is over almost. So we have one more quarter of uncertainty. I would expect some kind of revival to start from the first quarter of the next fiscal year.
Well, I'm afraid that's not a very happy way to start a discussion like this. But Ananth, would you agree with Jaggi's assessment? You know, Manish Sabharwal of Team Lease and member of the RBI Central Board says that instead of looking at the economy as heading into an ICU, we should look at it as getting out of a deep and broad rehabilitation. Would you agree with that assessment of Manish, that actually we're going to get better and better?
This is a different way of saying that the glass is half full rather than half empty. So I think he's right, that instead of getting into an ICU, it is getting out of a rehabilitation and into the recovery mode. I think, but the timeline still remains uncertain. To that extent, I agree with Jaggi that the recovery will be gradual. But I think Manish is right, that it is getting out of rehabilitation into the recovery mode, and hopefully with the passage of time, it will actually hit its stride even faster. So I would tend to agree with Manish Sabharwal than with the points of view expressed by several others, including the former CEA, that we are heading into the ICU.
Okay, so some cheer coming from Ananth. But Jaggi, the IMF has said that it will significantly lower India's growth estimate in January 2020. This comes after many others have already lowered their estimates, the lowest being 4.6% by Fitch. What is your best guess for 2019 and 2020?
Well, 2019, if you're looking at a calendar year, I would look at the lower end. But if you're looking at the fiscal year, I would put it slightly higher. So I would say somewhere between 6 to 6.5% with the range in which I look at it next year. So that will be the beginning of the recovery. The year after that, I would see a much higher growth rate, because we would have digested most of the difficult parts of the reforms, including your IBC, your GST fixing, and the slowdown in several critical sectors like real estate, construction, and also hopefully the governments will let the fiscal side be a bit loose in the next financial year which means that some of the money will start getting into people's pockets, reviving consumption, and to some extent followed by investment.
Okay. Anand, Jaggi made a very careful distinction between the calendar year and the fiscal year. Maybe you would also like to make that same distinction. And how would you see 2019 calendar year, fiscal year, 2020 calendar year, fiscal year? Anand?
I think in the Indian context, one has always given up looking at the calendar year perspective. So I will stick to the fiscal perspective. 1920 has only one more quarter to go, and I think the final number should be somewhere between 5 and 5.5%. And if you look at the 2020 and 2021, the next fiscal year, we should look at something like between 5.5 and 6, thanks to the base effect, etc. But with the risks somewhat tilted towards the downside. Before coming into this interview, I was going through the Article 4 assessment report of the IMF, and they have, pending the January revision, they have pegged the estimate for the next fiscal at 6.1%, with risks tilted towards the downside. And I think that sums up the point estimate and the balance of risks. So I would tend to go along with that forecast.
Okay. Jaggi, now let me pose a counterfactual. Sure, the growth numbers are dismal, the lowest in the past so many decades and so on. But should we look at growth numbers in isolation in terms of GDP growth rates, or should we put it in some kind of context, that is, examine it against the structural reforms that were done in the recent past? The GST, the Insolvency and Bankruptcy Code, inflation targeting, demonetization and so on, all of which have perhaps laid a strong foundation for future growth. And should our judgment of any year, or in fact of the year gone by, change once we do that? Jaggi?
Yeah, absolutely, Mythili. The issue is, like, let's not forget the immediate year after 1991 and the reforms, growth crashed to 1.5%. So when you have such structural changes, the economy takes time to adjust to the new normal, that the way of doing business has changed. And also there has been this emphasis on black money, tax compliance, higher less evasion, all those things have been there. So all these actually have a negative or depressive impact on growth. One more aspect I would like to bring in for growth. Let's not forget one thing, a lot of the growth is not actually getting captured, especially productivity. Like when you see a qualitative change in, let's say, telecom, but you have seen a huge crash in revenues and profits, GDP from the telecom sector will show a lower growth. But in actual reason, people are consuming 10 GBs a month and things like that on a per capita basis. That qualitative change in consumption is not being reflected in the monetary part of the GDP.
Well, there's something heartening to hear. In fact, Anand, Jaggi took the words out of my mouth, because 1991 was a watershed year in terms of the reforms, and GDP, it is true, plunged immediately after. But with the wisdom of hindsight, it is now quite apparent that those very same reforms that caused GDP to plunge immediately after did lay the foundation for a dramatic increase in growth in the subsequent years, making India part of the BRICS group, the group of fast-growing emerging economies, Brazil, China, Russia, South Africa, etc. So will posterity look back on the poor economic performance of 2019 as a price that we paid for necessary, if costly, reforms in the short term, Anand?
Whether the 2019 slowdown is the price we paid for structural reforms or not, as you correctly said, only history will be able to judge. Future historians will be able to judge better. But putting it in a context of what is happening in the entire emerging market space is important. If you look at the slowdown, it is not only India that has been going through this economic slowdown. Between 2018 and 2019, several major emerging economies have undergone slowdowns. So they were not exactly facing structural reform consequences. So I think India's slowdown, if you look at it in isolation, people are, I would say, probably hyperventilating about it. There is a slowdown, there is a concern, there are things that need to be done. We should do them, regardless of the short-term impact on the economic growth. But the slowdown, you have put it in the context of structural reforms, and Jaggi pointed out 91, 92, etc. But also, I'm adding one more context to it, that Indian slowdown is in the context of an overall emerging market slowdown. And the second context is, this is the first major economic slowdown in India post the advent of social media. So there is a lot of hyperactivism and commentary, and people expect the economy to turn around by the time the tweet is completed or a WhatsApp message is sent out.
Well, Anant, I'm not a big fan of social media, but the fact is that the Indian slowdown is more than it is in a number of other emerging markets. One cannot really dismiss it. But Jaggi, let me come back to you. You know, it's hard to put a number, especially when it comes to macroeconomics. But roughly, very roughly, how much of our present economic ills are due to outright policy mistakes, as in, say, trying to implement the IBC, the bankruptcy code, before we set our judicial house in order, the complicated GST rate structure and so on, and how much of it is due to poor implementation? To give the same example of GST, where, you know, we have the IT backbone, the GST, and it's still not able to cope with the numbers. The reason I ask is that it's much easier to spruce up implementation than to undo policy errors. Jaggi?
Yeah, I think we have a very complex economy with 29 states, now of course 28 states and 2 extra union territories. The point is trying to build consensus, political consensus to get any kind of GST through required you to make all those compromises, which is why we have a complex GST structure. We can get it fixed over say 2 or 3 years, that will happen, but in between we got hit by the slowdown, which is why it's slowing the process. If the Reserve Bank study is there, I think our GST average rates are actually far below the so-called revenue neutral rate of about 15%. It's more like under 12%. So, but we can't raise the rates in the midst of a slowdown. So when that happens, we'll have to start moving towards a more rational middle rate structure. So that's all there in the future. Yes, the problem about implementation is always going to be there in India, because you do not know the amount of pressure, technology is going to have to bear when people are constantly going to upload invoices, file returns and all these things. We've still not sorted it out.
You're entirely right on that, Jaggi. And not only is GST a work in progress, India itself is a work in progress, the one that we really want desperately to succeed. But I'm afraid it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with 2 experts looking back and looking ahead, looking back at 2019 and looking ahead at 2020. Anant, you know, the first half we discussed the state of the economy, but it's said that one must never drive looking at the rear view mirror. But you also need to understand the past in order to decide how to move ahead, which is why we spent the past few minutes giving our viewers some idea of the macroeconomic context. So now that we have done that, what are the possible remedies in the domain of monetary policy, fiscal policy, a combination of both, or do the remedies really lie outside the realm of both, Anand?
No, conventional policy measures do have to be taken. I mean, if you look at the fact that the latest IMF Article 4 report points out that Indian government's interest expenses themselves constitute 5% of GDP, higher than many other countries in the region, etc. So clearly, and RBI's Operation Twist was a welcome development, but they need to do more because if there is a substantial reduction in the risk premium which is embedded in the 10-year treasury, to that extent, it will definitely save government's interest payments. So therefore monetary policy still has a role to play, and people say that the fiscal policy does not have a role because Indian fiscal deficit on a combined central, state, public sector enterprises, off balance sheet borrowing, etc. is probably close to between 8 and 9% of GDP, etc. But we should remember, post 2008 crisis, UK, US and many countries went to somewhere between 10 and 11% of GDP, and then over the next several years they have brought it down to lower levels. And today the consensus is that monetary policy has limited effectiveness, whereas fiscal policy directly goes into the economy much faster, because interest rate cuts can go towards asset prices rather than to the real economy, etc. So many new empirical findings have questioned the limited effectiveness of monetary policy. So it needs to be there, but fiscal policy also needs to play. But these two will be short-term impact. They will have a short-term impact. But longer term, because this slowdown is a cyclical slowdown, but it has been compounded by the underlying structural difficulties that have always existed.
Jaggi, you know, talking in terms of solutions, structural reform is a catchphrase that many people seem to be mouthing, especially experts from multilateral organizations like the IMF. But reform, as we all know, will affect growth adversely in the short term. So is this the right time to push ahead when the economy is already slowing, or should we bide our time, Jaggi, for further structural reforms, labor reform, judicial reform, whatever you call it? Should we bide our time, at least temporarily, Jaggi?
Yeah, see, there are 2-3 things. First of all, I think in the short term, we must allow the fiscal policy to do its job, because we must allow a slippage, because monetary policy cannot do much. The reason is very simple. There is a gap between the policy rate cuts and how much has been transmitted. But transmission will speed up if you actually recapitalize banks, which of course is already happening in a big way. And if you take care of the NBFC crisis, you will actually find that transmission will be faster. As far as these big structural reforms are concerned, we have to, land and labor are important, but they themselves will not move the needle substantially on growth in the short run. Secondly, they are politically difficult in the context of today's thing. I don't know how much of these reforms will actually go through Parliament, because now after the CAA and other things, I think the opposition has smelt blood, so they may not be in a mood to cooperate on these reforms. But the more structural and very deeply needed reforms are reforms in judiciary, in education and in health. These three factors, if you see all our ease of doing business, we fare worst in these kind of areas where the settling contracts and those kind of things, we are somewhere at the bottom end of the pile. So judicial reforms needs the judiciary to cooperate, and you need to have a dialogue with the judiciary to get that done. You need police reforms, you need so many things, but those are things that will take 5 years minimum to conceive and do it. So we have to concentrate on the other things even while we set the ball in motion on this. Education reforms typically will take 5-10 years to put through, because whatever you do today will bear results after 10 years when people pass school and get into higher education. So I think many things are very long term in nature and will transcend one government, but they have to be begun now. The shorter term is focus on fiscals, focus on small labor and land market reforms and agricultural reforms. Those will actually start delivering after a year or two.
Yes, that is true, because there are no simple or quick answers. That is a reality. And in fact, Ananth, there is a view, and this is one that I subscribe to myself, that fiscal multipliers, that is the positive spin-offs from investment-led growth, are much higher than from consumption-led growth. But going by the calls for tax cuts, that seems to be a very minority view. Where do you stand in the debate on whether growth should be consumption or investment-led? I'm very firmly on the camp of investment-led. What about you, Ananth?
So I think any fiscal policy measure by reducing, let's say, GST rates for a short period that brings consumption forward, or some reduction in the personal income tax rates which puts more cash in the hands of the public, or for that matter by giving reimbursement to small and medium enterprises on the EPF contributions for hiring workers. This puts money in the hands of the small and medium enterprises. So these are the kinds of fiscal policy measures that will help, because ultimately it's about putting cash in the hands of small and medium enterprises and the households to create short-term aggregate demand growth. Now, investment-led growth, yes, government spending on infrastructure is happening, on roads and railways and ports are happening, and to the extent wherever possible, government can definitely push ahead on those areas where the projects are stalled.
But Jaggi, the fact is that the government can only nudge consumption. You can lower tax rates, put more money in the hands of people, but they may not necessarily spend. Whereas it can drive investment directly by spending directly on road building, bridges, etc. So shouldn't investment spending be an automatic choice at a time when the private sector is not investing? Simply because when the government spends, does capital expenditure, assets get created, their spending takes place, money gets into the hands of people. So isn't that a better way of going about it, Jaggi? So why are these calls for consumption, boost consumption? Jaggi?
Yeah, absolutely. And I completely agree with you on this, that we have to be investment led. And for that, we should even temporarily keep all investment spends by the government outside the fiscal deficit calculation, at least till the economy stabilizes. Say that anything that's spent purely on investment should not be included in the fiscal deficit, which will sound horrendous, like 9 or 10% states and center put together if you actually take it. So all these should be kept out. The second thing is more important than just investment. I think if the government simply clears all its bills to the private sector, to the small sector, to its contractors and everybody, they have not been paid, I mean, if you don't pay them, so your consumption will start the minute you start paying for all the services you have used, So if the government just clears all its bills, and that will add to the fiscal deficit or cash outflows, but it will create better conditions for growth.
So Anand, let me ask you, because how much does the external sector matter? Because we saw in 1890, 1920, the trade wars between China and the USA really impacted trade, and that did also take a hit on our GDP growth. So how difficult do you see 2020 in terms of the external sector?
I think it will continue to remain difficult. It will continue to remain difficult because global economy, especially the US, has been in its 11th year of expansion, and asset markets are quite elevated in valuation. In fact, IMF Article 4 report also mentions the three downside risks for India. One is they mention potential turbulence and volatility in financial markets, higher oil prices, and internal development. So they mention these two external factors as major risk factors. So if anything, I would say India, for the growth for the current slowdown to bottom out and then the growth to recover, it's not so much internal difficulties in 2020, it is the external difficulties that will be the bigger risks or obstacles. And in that sense, I would say export growth in 2020 will not necessarily be a big contributor to the revival. It has to come from internal actions and internal spending.
That's true. We don't have much control over the growth of our exports. But Jaggi, will this become a significant deterrent to our growth rate?
No, I think exports have not been a huge contributor to growth except in those boom years between 2003 and 2008. And even there, a lot of the exports were fluff actually. If you look at it, when you had an oil price regulatory regime which kept the prices below market rates, you actually had the biggest export growth was in POL items. So if you remove all that from the export data of those years, you will find that the export growth was not exactly that kind in which the official figures suggest.
Okay. Anant, we're almost running out of time. So let me end with asking you the one last question that really looms over the macroeconomy today, and one that I carefully avoided in a bit to limit the discussion to the economy. And this is regarding the political overhang or the kind of violent protests we're seeing now all over the country over the Citizen Amendment Act, the NRC, etc. Do you see it impacting the economy significantly, or will it pass?
I personally would take the view that it will pass, because most of these things happen on the eve of elections, etc., and then they die down. And if you look at the kind of issues raised before many state elections in the last 4 to 5 years or 6 years, I don't think they have contributed in a very meaningful way to the economy in terms of slowing it down. So I would see this as a temporary phenomenon that would wash out rather than show up in the economic growth data.
I hope you're right on that, Anand. Jaggi, would you agree with that? Because the last thing we can afford really is to have political and social tension at the time when the economy is also slowing. Jaggi?
Yeah, I think as long as the government makes it clear that it will not proceed with NRC, which is the more scary bits which people have talked about, that it will not go through without a political consensus. If it makes a simple one-line statement, I think most of the political hangama will die down. And I'm also hoping that after the chastening defeat of the BJP in Jharkhand, the government will say, look, let's focus on the economy. That's where our future political growth will be there. So, and the government cannot rely only on politics for this thing. Now that its footprint has shrunk, it should focus on the economy. And I think wise minds will say, fix the economy and the politics will go in your direction after that, after a lag.
Okay, I really do hope you're right on that, but I'm afraid we've run out of time completely. So I'll have to end this discussion now. The only consolation is that we've given our viewers enough food for thought, and I also hope, reason to hope, as they ring in the new year. So on that note, let me wish all our viewers a peaceful and happy 2020 from all of us at ET Now. Remember, we'll be back next week with yet another edition of Macros with Mythili. Thank you very much, Jaggi and Anand, for joining us in this very interesting discussion.